All right, so here's the chapter one lecture video. And in chapter one, we're going to be discussing some of the basic concepts of business. We'll look at the different types of business organizational forms, and we'll also discuss the basic financial statements that you're going to be preparing in chapter one. And I think for most of you who have taken applied accounting, you're going to find that there's a lot of review in here. But there's also a couple differences in terms of how we describe equity and so forth. So we'll get started. So again, first thing we're going to get into here is, again, the organizational forms of the business. And again, most of you probably know this. We've got what they call the sole proprietorship, the partnership, and the corporation. And of course, we know a sole proprietorship is owned by one person, and they are personally liable for all the debts of the business. So this is always, they say, the most risky form. Then, of course, you move up to a partnership where you've got two or more, and everybody kind of shares, the partners share, they're jointly liable for all the debts. And of course, you could always have, you could have 1,000 partners if you had one, like some of the CPA partnerships, but typically just keeping it simple, two or more is partnership. And then the corporation, which is the only of the three, it's the only taxable separate, what they call legal entity. And again, the owners of the corporation, they are not personally liable for the debts. So basically, if you are a stockholder, you are a part owner of a corporation, and your risk is simply you could lose your investment if something goes bad. They can never come after your personal property. So again, the corporation is the only taxable legal entity. And in terms of ownership, you only have to have one person to be a corporation, or you could also have thousands of owners, but the minimum requirement is one. Okay, so again, that's just a little bit of review, again, from applied accounting. All right, in the next couple slides, we'll walk you through. We've got, basically, they're kind of telling you a little survey in terms of most types of organizational forms in the business. And as you can see, no surprise, a big part of it is the sole proprietorship idea. There's a lot, that's kind of like the American way. A lot of people have their own business. But notice number two, in terms of their survey, was the corporation. All right, let me go to the next slide. So again, the accounting system, typically, if you go back and look at your basic definition of accounting, of course, the accounting system analyzes, records, summarizes, and reports on these business entities. And of course, we've got external users using these financial reports, and we've got internal users. Primarily, the focus in this class when we get to preparing the financial statements is because we're following GAAP, because most of the entities we're going to be reporting on is that corporation. A lot of it involves the external users. But again, internal users still use the same information as well. But again, like I said, external users evaluate, and the internal users, they'd run the company. So everybody kind of has a stake to make sure that the company is doing well. All right, next objective is we'll get into the basic financial statements. You probably did 3 of them in if you took applied accounting, but we'll get to that. You most definitely looked at the accounting equation, which is the fundamental framework of when you analyze transactions. So remember, just your assets is what you own, liabilities is what you owe, and then of course the equity is going to be what's left over. And don't forget the separate entity assumption. That still applies. That's simply where you don't, commingle the personal assets of the owners with the business entity. The business entity, in other words, has its own set of financial records. All right, just a couple basic definitions. Here's your technical definition. I know you know what examples of assets, but they like to say that assets have some sort of measurable value and also produce some sort of benefit to the company. All right, so we've got cash, supplies, furniture, equipment. These probably are going to be your main categories of assets that you're going to find in most examples. Regarding liabilities, we'll have accounts payable, typically, and notes payable. And when we look at the accruals, we'll probably have like wages payable. You could have interest payable, but these are the 2 main types. Typically, the main difference between a note payable and accounts payable is that notes payable usually involves some sort of interest owed, whereas accounts payable is usually interest free. All right. And then of course, the equity. And on your equity, I didn't do this earlier, but typically the way I like to draw this out, if I were to illustrate just the definition of owner's equity, and then let me get my stylus on here for a second. I tend to like to define it within the framework of the accounting equation. But if you were to take your assets and subtract out your liabilities, typically what's left over is your equity. Now, the one thing that's going to change with the financial accounting that you didn't have it applied is really we're going to divide equity into two parts. We're going to have what they call the common stock, and then the other part's going to be called retained earnings. And in applied accounting, we just call this capital. And if you also recall, we also did something in applied accounting where we talked about these equity transactions. There's like 4 of them. Well, typically your common stock would represent your investments. That's one category. And then your retained earnings would have the other 3 categories, which would include revenue. You would have expenses, so that would be what the 3rd one. And then of course we're going to have a category called dividends, which is very similar to owner's withdrawals. So what will happen is the revenues and expenses will be summarized on your income statement, but it's all going to be transferred eventually to this thing called retained earnings. So just to kind of keep it simple, equity in financial accounting, again, will have 2 parts. You'll have common stock, that's one of them, and then you'll have retained earnings, and add them both together, that's going to be your overall equity. Okay, next slide. So again, this is just talking about, again, how to calculate net income. And just remember, of course, your revenues is your inflows of what your normal course of business does, generate revenue. Of course, the expenses is the cost to run your business. These are some examples in your wages, utilities, insurance, and so forth. But if you take your revenues, which is kind of like your cash inflows, subtract out your cash outflows, the difference is either net income or net loss if your expenses are greater than your revenue. And of course, dividends are just distributions. Companies like to reward their investors for being an investor. And so they'll get a dividend payment. And notice, again, I said this earlier, the revenues and expenses, which usually get summarized into net income, will be showing up on the retained earnings statement eventually. And then your dividends also will come out of retained earnings. So remember, of the 4 equity types of transactions, 3 of them will be involved with retained earnings. All right. In terms of the order, this is very similar to what you did in applied accounting. Income statement's the first one. Statement of retained earnings, which in applied accounting, we just called it your equity statement, owner's equity, but now we're calling it the statement of retained earnings. That's number 2. And then the balance sheet will be number 3. And then the new one we'll be doing in this chapter will be called the statement of cash flows. So the next couple of slides, again, we'll just go through some of the views of what an income statement looks like. And again, I'm not going to talk too much because I think most of you probably know this, but you'll notice how we have a revenue category. Well, you got the name of the company, the title, of course, of the financial statement, and always note that there's always a time period for the month ended September 30th. Notice here's your revenues, here's your expenses. Revenues minus your expenses, of course, gives you net income or net loss. Now, this number then, this 2,000 will then be transferred because it's a summary of your revenues and expenses. It will be transferred then to your statement of retained earnings. So you'll notice, again, on the statement of retained earnings, there's that net income, and then you subtract any dividends to get the ending retained earnings balance, and then this balance is what's going to show up, of course, on your balance sheet. All right, on the next slide, again, here's your balance sheet. Notice we've got which is essentially your financial, your accounting equation. Here's your assets listed, total assets. And of course, your total assets have to equal your liabilities and equity. Notice here's your total liabilities. There's that retained earning balance from your retained earning statement. We add these 2 together. Notice the 36,000 you are balanced. This is, again, is your basic accounting equation. Now the next one is new, and we won't actually get to this until later in the semester. I believe it's chapter 12 even. There's a lot of stuff to cover. But notice the statement of cash flows assesses like how a company is using its cash. You have three categories. You have what they call operating, investing, and financing. And each of these categories will have inflows and outflows. And then at the end, they will show you simply what the ending cash balance is. And this will be the cash balance that's also reported on your balance sheet. Notice at that point in time. Okay. All right. So that would be that one. And of course, usually most financial statements accompany some sort of note just to describe the different accounting processes and GAAP rules that the company is using to how do they account for the different accounts, whether it's inventory, which we'll be getting into different types of inventory methods, whether it's accounts receivable in terms of how we're reporting it, but it's hopefully it's to help the user make decisions and interpret what's going on in the financial statements. Okay. So again, like I just said, and again, this is kind of like a little repeat, but I'll just say it again so you get it. So remember, your net income transfers to retained earnings, and then whatever you end up with retained earnings, which summarizes net income and your dividends, that will be the balance that then goes on the balance sheet. And you'll notice again, there's your equity. And of course, notice the cash flow statement. This balance of 13,000 should be the same number that shows up on your balance sheet. Okay, so now we'll talk about a little bit about how financial statements are used. And so typically, if you're a creditor, you're set, everything's usually assessing risk, cost benefit, but creditors typically want to know, do you have enough money to pay? Do you have enough assets to cover your liabilities? Investors are looking for typically return. What can they get back on their investment? Could be short term or even long term. So there's a lot of different ways you look at it. I can tell you that Warren Buffett, you guys have probably heard of Warren Buffett, but typically he always looks at a company's cash flow initially when he's deciding if he's going to buy stock, because cash flow is key to determining if they have enough money to run their business. All right. Useful information, some basic things about useful information. Again, this is for external financial reporting. And remember, the main goal is that we need to provide useful information for decision making. Useful meaning it should be relevant and faithfully represented, which all falls under this timely. That means information should be timely, verifiable, meaning it's legitimate, comparable, so you can compare year to year, month to month, and also making sure that the financial statements are understandable. In terms of who develops these, in the US, we've got the FASB, and of course, we're studying GAAP. If you're outside of the US, typically there's what they call the International Accounting Standards Board, or IASB, and they developed this thing called IFRS. And there's been a lot of talk the last several years about trying to reconcile the differences between the generally accepted accounting principles, GAAP, and IFRS, or IFRS. And so what happened is that the FASB and the IASB were trying to come up with some project where we could just have one set of global rules, and it never happened. Nobody could ever agree to decide who should have the appropriate rules. And so long story short, the project didn't work. And so we still have the GAAP, and there's still the IFRS. There's still some differences. I do believe they still test it lightly. It used to be tested a little more heavily on the CPA. But if some of you end up trying to take the CPA, they will definitely talk to you about how much content you have to know about that. Okay. All right. That's most of it. The next thing, again, in this chapter, look at ethics. There's a little thing about ethical conduct. Again, identifying the situation, evaluating courses of action, and of course, choosing what's the most ethical. All right. All right, accounting careers. You've probably been through a lot of this from your applied accounting. There's a lot of different ways you can go. Accounting is good for just about any major, and you can kind of like look through this slide, but I can tell you if you're in finance, marketing, HR, production, it always helps to understand the record keeping and the accounting and the financial statements. It will never hurt you to know this stuff. And typically, even if you're not in accounting, they typically make you want to, they make people go back and get more accounting knowledge just because it's what they call, again, the language of business. You have to know. All right. public companies, there's a couple slides I'll comment about, you know, why companies do go public and the implications for accounting, and a lot of it has to do with regulation. But mostly what happens is if a company goes public, meaning they can sell stock, notice it says they keep the money it raises when it issues shares. So it's a good way to generate some money. They call it capital. And it's also future, by selling future shares of stock, it's, again, you can get more cash in the business. And of course, if you have more cash, then you can help grow your business. And you know, you can also give incentive to your employees. So you're going to retain the top talent. They're going to get more money. And of course, you know, you can buy other companies by paying with shares rather than the cash. So there's a lot of benefits to going public. But remember, if you do go public, it's not cheap. And of course, you have to follow a lot of government regulations. There's also greater risk if you misstate anything in the financial statements because the public is looking at it. And there's, again, increased accounting disclosures, accountability. You have to follow the Sarbanes-Oxley Act, and which again is not cheap. So it's very expensive, and there's a lot of rules that you have to follow if you decide to go down that path. And of course, you can see some different things about when a company goes public. They have press releases, financial reports. They have to, in fact, before they even go public, they have to prepare a lot of financial statements to the SEC just to prove that they have the ability and they meet all the rules of the Securities and Exchange Act of, I think it's 1933 or 1934, to be able to sell stock publicly. All right, I think there's a couple more slides. I think the rest of them is just one little problem. On this one, they're showing you if you were going to prepare a statement of retained earnings for 2 years. So they give you the net incomes, they give you the dividends, and it's assuming it's the first 2 years of operations. So again, in the next slide, they'll show you, as you see, that for the 2017, notice you had zero, you added income, you pay your dividends, that's your ending retained earnings for 2017. And then this balance will transfer to the beginning of 2018, add net income, subtract the 2018 dividends, and then that would be the retained earnings for the second year. That's all you have to do. It's pretty simple. All right, I believe, and then I think there's one more. Let's see the balance sheet. And this one, it just says, you know, prepare a basic balance sheet. And then, you know, they want to know about the financing. So if you look at this, you can see how, again, here's your assets, total assets. You have two liabilities, and of course, here's your common stock and retained earnings. Notice that you are in balance. So this is your basic balance sheet. All right, so that's the end of my comments for the Chapter 1 lecture video. Again, I think you'll find that there's a lot of review in Chapter 1, and then again, I think the retained earnings and just the concept of a cash flow statement will be some of the new stuff that you probably haven't seen just yet from your applied accounting.